In 2025, Wall Street found a new way to profit from disaster. Catastrophe bonds hit record highs, with $7.1 billion issued in the first quarter alone, and a total outstanding market, now over $52 billion. These financial products don't require solving climate change. They turn disaster risk into an investment opportunity. Goldman Sachs and JP Morgan employ teams of climate PhDs and data scientists to build models that price the likelihood of hurricanes, wildfires, and earthquakes. Moody's Swiss Re-Cat Bond Index returned 17.3% last year by quantifying risks that rarely move with the stock market. These bonds promise double-digit yields for investors, but the money only arrives after disaster strikes, not before. This market has grown rapidly, while traditional investments struggle with volatility. The $50 billion catastrophe bond market. The scale of the catastrophe bond market is now impossible to ignore. By the end of the first quarter of 2025, the outstanding market size reached $52.2 billion, up 17% from a year earlier. This figure marks the latest in a series of record-breaking years for catastrophe bonds, a financial product designed to transfer the risk of natural disasters from insurers to investors. The strong momentum in 2025 follows a record $7.1 billion in new issuance during Q1 alone, with broker-dealers expecting an additional $15 to $19 billion in new deals before the year is out. The market's expansion is not just a story of numbers. It reflects a fundamental shift in how risk is monetized and distributed across the global financial system. Catastrophe bonds, or CAT bonds, have found a permanent place in the portfolios of institutional investors. BlackRock, the world's largest asset manager, now holds $8 billion in CAT bonds, while Nephila Capital manages over $7 billion in insurance-linked securities across a spectrum of disaster risks. These bonds attract pension funds, sovereign wealth funds, and insurance companies seeking stable, high-yield returns that are largely uncorrelated with equities or fixed income. The California Public Employees Retirement System, for example, allocates more than 3% of its assets to catastrophe instruments. Norway's sovereign wealth fund has steadily increased its allocation as well. What draws these investors is not just the potential for yield, but the structure of the returns themselves. In the first quarter of 2025, CAT bond spreads hovered around 7 to 8% over treasuries, compared with 3 to 4% for comparable corporate bonds. The Swiss Re-Cat Bond Index posted a 17.3% total return in 2024, its second highest annual gain on record. The appeal is straightforward. These returns are driven by the occurrence, or non-occurrence, of disasters, rather than by the ups and downs of the broader economy. As a result, CAT bonds offer a rare form of diversification at a time when traditional markets are increasingly correlated and unpredictable. The range of risks covered by catastrophe bonds has expanded dramatically. Early CAT bonds were limited to well-defined perils like Category 5 hurricanes in the Gulf of Mexico or magnitude 7.0 earthquakes along the Pacific Rim. Now, the contracts are far more granular and adaptive. In Q1 2025, for instance, bond triggers specified that payouts would occur only if hurricane winds exceeded 111 miles per hour within tightly drawn coastal coordinates, or if floodwaters in certain South Florida neighborhoods rose above 12.75 feet on the NAVD 88 elevation scale. Wildfire bonds have adopted similar precision, relying on satellite-confirmed burn areas and real-time air quality data to determine when capital is released. Beyond the classic natural disasters, the market is pushing into new territory. Water scarcity bonds, first issued in 2024, link payouts to reservoir levels in the drought-stricken American Southwest. Climate migration bonds are tied to the number of people displaced after events like wildfires or hurricanes. The inclusion of cyber risk is a recent and notable development. The first cyber catastrophe bond was issued in January 2023, with a second following just a year later. These innovations reflect a market that is both responsive to the changing nature of global threats and eager to monetize them. Geopolitical risk has also entered the picture. The first half of 2025 saw a wave of conflict-linked catastrophe deals, as reported by Reuters, although the details remain closely guarded by issuers and sponsors. Unlike traditional insurance, these instruments can be structured to respond to a broad range of triggers, from the physical destruction of infrastructure to the economic impact of sanctions or blockades. The flexibility of the CAT bond market allows it to adapt quickly to new sources of uncertainty and volatility. The mechanics of these bonds are complex, but the logic is straightforward. Each contract spells out precise triggers in its prospectus. A hurricane bond might require sustained winds above a certain threshold in a specific region. A wildfire bond could demand confirmation of a minimum acreage burned, cross-referenced with air quality indices and satellite data. Flood bonds use elevation markers and rainfall measurements. The latest generation of contracts even accounts for so-called secondary perils, events like mudslides that follow wildfires or outbreaks of disease after major floods. Secondary market activity is robust. In the second quarter of 2025, over $10 billion in new issuance hit the market, and trading volumes remain high as investors rebalance their exposure in response to evolving forecasts. Electronic trading platforms now enable real-time swaps of catastrophe risk as weather systems develop and shift. Some hedge funds specialize in buying distressed bonds during ongoing disasters, betting that the final damage assessments will fall short of initial projections. This dynamic creates a market where risk is not just transferred, but actively traded and repriced as new information comes in. The contracts themselves have become so detailed that they resemble financial blueprints for disaster. Payouts may depend on the number of hospital evacuations, the closure of schools, or a drop in tourism revenue. Some bonds are linked to insurance claim volumes, or even to the volatility of cryptocurrency markets during periods of extreme weather. The boundaries between natural catastrophe, economic disruption, and financial engineering are increasingly blurred. For the sponsors, typically insurers and reinsurers, cat bonds offer a way to offload risk and free up capital. For investors, they provide a chance to profit from volatility that is uncorrelated with the stock or bond markets. But the real engine behind the market's growth is the relentless refinement of risk models. The more precisely a disaster can be predicted, the more efficiently capital can be allocated, and the greater the potential rewards for those willing to take the other side of the bet. This is the central paradox of the catastrophe bond market. These contracts do not prevent disasters or mitigate their human cost. Instead, they reward those who can most accurately forecast the scale and impact of destruction. The industry's brightest minds are now dedicated to building ever more sophisticated models of risk, with the goal of turning each new threat into a source of profit. As the market continues to grow, the focus shifts from managing disasters to predicting them with unprecedented accuracy. That accuracy is no longer just a matter of experience or intuition. It increasingly depends on advanced data analytics, machine learning, and artificial intelligence. Tools that can process vast streams of information from satellites, weather stations, social media, and financial markets. The next phase of this market is defined by the race to build the best predictive models, and the competition is fierce. The institutions that succeed are not necessarily those with the longest history in insurance, but those that can recruit the top climate scientists, data engineers, and AI specialists. The result is a financial ecosystem where the value of a bond depends not just on the likelihood of a hurricane or wildfire, but on the precision of the models that predict them. Investors and sponsors alike are betting on the ability of technology to see into the future and to quantify human suffering down to the smallest detail. In this world, the line between science and finance grows thinner each year. As catastrophe bonds become more embedded in the global financial system, the incentives for ever more accurate disaster prediction grow stronger. The next chapter in this story is not about the disasters themselves, but about the technology and expertise used to anticipate them. The market now rewards those who can harness artificial intelligence to refine their forecasts, and the stakes have never been higher. AI-driven disaster prediction. Banks like Goldman and JP Morgan now rival government labs in climate modeling capacity. Their teams of climate scientists and data engineers no longer focus on solutions like renewable energy or carbon capture. Instead, their work centers on refining proprietary models that dissect every variable driving disaster risk. The objective is not to prevent destruction, but to quantify it with enough precision to structure profitable financial instruments. In this world, the sharper the forecast, the more exact the payout. Machine learning systems now process billions of data points to map wildfire risk, far surpassing the 100,000 simulation approach of traditional models. These AI-driven tools pull in data from dozens of satellite constellations, historical weather archives, and real-time environmental feeds. JP Morgan's wildfire model, for instance, incorporates live moisture readings from specific tree species, wind velocities at multiple elevations, and even the maintenance histories of transmission lines in fire-prone corridors. These algorithms outperform government forecasts by drawing on unconventional sources. During the 2024 California fires, some systems ingested social media posts about smoke sightings, recalibrating risk triggers as the disaster unfolded. The models have evolved far beyond predicting the physical footprint of a disaster. They now estimate losses at the level of individual neighborhoods or city blocks. A hurricane model might project the precise number of hotel bookings lost in Miami Beach as storm surge projections shift. Another could anticipate the impact of flooding on grain futures by tracking water levels in specific Midwest silos. In this environment, meteorologists are valued for their ability to translate atmospheric signals into financial risk, not public safety. This demand for specialized talent has transformed the job market for climate scientists and meteorologists. Quant firms and asset managers actively recruit PhDs from leading programs, competing with research institutions for expertise in atmospheric modeling, hydrology, and geospatial analytics. The financial incentives are clear. The ability to build a model that can predict a wildfire's path or a hurricane's impact down to the street level can be worth millions in bond structuring and trading. The disaster prediction sector has ballooned into a $3 billion fintech industry. Startups carve out niches, offering hyper-specific models. One firm focuses exclusively on hurricane risk to semiconductor factories in Taiwan, while another tracks glacier melt rates to estimate flooding threats to European cities. The most valuable firms maintain proprietary datasets unavailable to governments, such as real-time structural stress readings from critical infrastructure or high-resolution satellite imagery of remote regions. Verisk, a major player in catastrophe modeling, has implemented machine learning approaches across the entire spectrum of disaster risk. Their neural networks analyze decades of weather data to simulate tropical cyclone precipitation patterns with a level of detail that traditional models cannot match. For example, Verisk's AI-driven tropical cyclone precipitation model can simulate 100,000 seasons in weeks, compared to the months required by earlier technology. This allows for more robust scenario analysis and faster pricing of risk. Verisk has also developed artificial neural network models to monitor major reservoirs. These systems use historical storage data, precipitation patterns, and operational rules to forecast water shortages, giving investors the ability to anticipate drought declarations before they are made public. In Southeast Asia, Verisk's algorithms scan satellite images to identify clusters of high-rise buildings in regions lacking official geospatial data. The software recognizes building shadows and rooftop shapes, flagging high-risk structures in informal settlements, critical information for reinsurance contracts. Some models even track social media sentiment during disasters, adjusting risk scores in real time as panic spreads and official reports lag behind. Insurers are fundamentally overhauling their catastrophe modeling strategies with AI and machine learning. Traditional actuarial models, once the backbone of the industry, can no longer keep pace with the volatility and complexity of climate-driven risks. AI-powered tools now handle vast, data-led tasks, such as analyzing aerial imagery to assess property-level vulnerabilities. Algorithms can identify cracked foundations in Texas suburbs or degraded roof shingles in Florida, recalculating premium rates before human inspectors are even dispatched. These systems cross-reference micro-level property features with climate projections, flagging homes that may soon become uninsurable. Moody's recent acquisition of Cape Analytics exemplifies the industry's pivot toward property-level AI risk insights. Cape's models leverage satellite and aerial imagery to deliver real-time assessments of property conditions, feeding directly into catastrophe bond pricing and insurance underwriting. The integration of these tools enables more granular risk segmentation and more dynamic adjustment of exposure as conditions change. Swiss Re and other major reinsurers have linked catastrophe bond yields to interest rate benchmarks, using AI models to recalibrate payouts as macroeconomic conditions shift. This innovation allows for more flexible risk transfer products, aligning investor returns with both disaster occurrence and broader financial market trends. The refinement of these instruments depends on the relentless improvement of predictive models. Each new layer of data, each uptick in accuracy, translates into tighter spreads and higher profits. The technology has introduced new efficiencies, but also new forms of speculation. During the Mediterranean heatwave of 2024, trading algorithms automatically executed purchases of water scarcity bonds as soon as temperature models predicted. Prolonged drought. In some cases, payouts were triggered before local governments had even finalized emergency response plans. In Texas, energy traders use wildfire prediction models to speculate on electricity futures, anticipating which transmission lines will likely fail as fire risk escalates. Disaster prediction models now influence the behavior of entire communities. Some coastal towns have delayed infrastructure upgrades after discovering that their catastrophe bonds pay out more if outdated seawalls are damaged. In Nevada, zoning officials redrew wildfire corridors in response to analytics, showing that denser clusters of flammable properties would increase potential bond yields. The models are not just passive forecasts. They shape incentives, sometimes in perverse ways. The ethical dilemmas facing climate scientists and finance are stark. Some researchers who once built models to aid conservation efforts now see their work repurposed for financial gain. A coral reef bleaching algorithm, developed to inform restoration strategies, might be adapted by a bank to structure bonds that profit from marine ecosystem collapse. Meteorologists who once issued hurricane warnings for public safety now find their forecasts used to time short positions on insurance stocks. The closer their models get to perfect prediction, the more lucrative the outcomes for those trading on disaster. The disaster prediction arms race shows no sign of slowing. Firms are already experimenting with quantum computing to simulate thousands of climate scenarios simultaneously. Early prototypes can adjust bond terms in real time as a hurricane shifts course, recalculating potential payouts based on minute-by-minute changes in wind speed or storm surge. Blockchain-based prediction markets have emerged, where traders speculate on evolving disaster metrics hour by hour, creating a new layer of liquidity and volatility. Verisk's machine learning ensembles, for example, now simulate precipitation patterns for tropical cyclones with a fidelity that allows for more precise flood risk pricing. These advances make it possible to issue bonds tailored to ever narrower slices of risk, specific neighborhoods, infrastructure corridors, or even supply chains. The technology is also being used to monitor the behavior of major reservoirs, using artificial neural networks trained on decades of storage and precipitation data to forecast when water shortages will tip over into crisis. In Southeast Asia and other rapidly urbanizing regions, AI-driven analysis of satellite imagery has replaced on-the-ground property surveys. Algorithms identify high-rise clusters and informal settlements, flagging areas where building collapse or fire risk is highest. This information feeds directly into reinsurance contracts, allowing for rapid repricing of risk as new data arrives. Some models even monitor social media and news feeds to detect early signs of panic or disruption, adjusting risk assessments faster than traditional reporting channels. Insurance firms have embraced AI-powered risk assessment tools at the property level. Machine learning models analyze aerial imagery to detect early warning signs of structural weakness, from cracked foundations to missing roof tiles. These insights are cross-referenced with climate projections, enabling insurers to identify which properties are likely to become uninsurable as climate risks escalate. The result is a feedback loop. As models grow more accurate, insurers adjust their portfolios, and the financial system's exposure to disaster risk becomes more tightly managed. The financial sector's appetite for ever more precise disaster prediction has given rise to a sprawling network of fintech startups, data providers, and analytics firms. Some specialize in modeling the impact of hurricanes on semiconductor supply chains. Others focus on glacier melt and flood risk for European capitals. The most valuable assets in this ecosystem are proprietary datasets, high-resolution satellite imagery, real-time infrastructure monitoring, and granular social data that remain inaccessible to public agencies. Despite the sophistication of these tools, the fundamental contradiction remains. The models that could help communities prepare for or mitigate climate disasters are instead optimized to maximize returns for investors. When predictive accuracy approaches near certainty, the benefits accrue to those who can monetize the outcome, not those who bear the brunt of the disaster. The technology grows sharper each year, but the incentives remain unchanged. Destruction becomes a source of profit, not averted loss. AI's precision powers profit, but fails to stop disasters. The next frontier in risk modeling is not just natural hazards, but the engineered chaos of geopolitical conflict. War bonds 2.0. Financial markets have begun to treat geopolitical conflict as just another variable, one that can be priced, modeled, and traded. War catastrophe. Bonds, often called war bonds 2.0, now exist alongside the more familiar weather-linked instruments, offering investors a way to profit from instability and destruction. These bonds are structured to cover a range of perils, from drone strikes and cyberattacks to disruptions in global supply chains. The logic is straightforward. If a defined conflict event occurs, the bond pays out. If not, investors collect steady returns for assuming the risk. The emergence of these instruments marks a shift in how risk is understood and managed. According to recent reports, the catastrophe bond market is rapidly diversifying, with cyber risk and conflict-related perils now servicing a growing share of investor demand. Reuters noted that in the first half of 2025, issuance of catastrophe bonds, including those tied to geopolitical events, reached $10 billion, with momentum building as institutional investors seek alternatives to traditional climate-linked products. Gallagher Re, another market observer, described a clear uptick in conflict-related insurance-linked securities, reflecting the financial sector's appetite for new sources of volatility. The design of war catastrophe bonds resembles that of their climate counterparts, but the triggers are tailored to the unique characteristics of modern warfare. Some contracts specify payouts in the event of a coordinated cyberattack on a national power grid. Others are activated by disruptions to semiconductor exports in the Taiwan Strait, or by the closure of critical shipping lanes. The sophistication of these bonds has increased as underwriters incorporate real-time data feeds, satellite imagery, and even social media analysis to determine whether contractual thresholds have been met. In effect, the chaos of war is rendered legible to financial markets, made quantifiable and tradable in the same way as hurricanes or wildfires. Investor interest is not limited to hedge funds and asset managers. Middle Eastern sovereign wealth funds have emerged as major players, allocating substantial capital to war-linked catastrophe bonds as part of their broader risk management strategies. Private military companies, too, have entered the market, using these instruments to hedge operational exposures in volatile regions. The layering of financial and military interests creates a web of incentives that is difficult to untangle, with each party seeking to profit from the uncertainty that conflict brings. The expansion of catastrophe bonds into cyber risk has been particularly rapid. John, a hedge fund manager specializing in these products, described the demand for cyber risk coverage as set to explode. The logic is familiar. As the frequency and intensity of cyberattacks increase, so does the need for financial instruments that can absorb the resulting shocks. New contracts now cover everything from ransomware attacks targeting banks to systemic breaches of central bank infrastructure. The boundaries between traditional warfare and digital conflict have blurred, and the bond market has adapted accordingly. The ethical questions raised by these developments are significant. The same financial institutions that underwrite weapons sales and defense contracts now structure bonds that pay out when those weapons are used. Critics argue that this creates a system where human suffering is transformed into a speculative opportunity, a mechanism for turning violence into profit. The financialization of conflict does not resolve the underlying causes of war. It simply monetizes the consequences, distributing risk and reward across a global network of investors. Legal frameworks have struggled to keep pace with these innovations. Many war-linked catastrophe bonds are issued in offshore jurisdictions, where regulatory oversight is minimal and contract language is carefully crafted to avoid explicit references to war. Terms like geopolitical volatility event or systemic security disruption are used in place of more direct descriptions, allowing issuers to sidestep scrutiny and maintain access to a broad pool of capital. The opacity of these structures makes it difficult for outside observers to assess the true scale of the market or the nature of the risks being traded. Pension funds, in search of uncorrelated returns, have begun to allocate a portion of their portfolios to war catastrophe bonds. The rationale is straightforward. These assets tend to perform well when traditional markets are roiled by geopolitical shocks. Some funds attempt to justify their participation by pledging to direct a share of profits to humanitarian causes, but critics argue that this approach does little to mitigate the underlying moral hazard. The reality is that, for many investors, the promise of steady income outweighs concerns about the source of those returns. The secondary market for these instruments is active, with trading volumes spiking during periods of heightened tension. Specialized desks at major banks monitor developments around the clock, adjusting positions as new information emerges. The most successful traders are those with a deep understanding of both financial modeling and the dynamics of modern conflict. Former intelligence officers and military analysts now find roles on Wall Street, translating battlefield developments into actionable financial strategies. The modeling infrastructure behind war catastrophe bonds is designed to process vast amounts of data in real time. Quantitative teams repurpose algorithms originally developed for military applications, using them to estimate the probability and impact of specific conflict scenarios. Satellite imagery, intercepted communications, and open-source intelligence are fed into these systems, allowing for rapid recalibration of risk as events unfold. The result is a market that responds to the ebb and flow of global instability with unprecedented speed and precision. The normalization of these instruments has been facilitated by the integration of war bond indices into mainstream financial platforms. Bloomberg terminals now display conflict-linked risk metrics alongside traditional fixed income products, making it easy for investors to compare opportunities across regions and perils. As standardization increases, liquidity grows, and the line between climate and conflict risk continues to blur. For many market participants, the distinction is largely academic. Both are sources of volatility that can be modeled, priced, and traded. Critics warn that the proliferation of war catastrophe bonds may have unintended consequences. As more capital is allocated to instruments that pay out in the event of conflict, there is a risk that financial incentives could influence policy decisions or prolong instability. Heavy investment in bonds linked to specific flashpoints may create the perception that conflict is inevitable, shaping the expectations of both policymakers and market participants. The feedback loop between finance and geopolitics becomes ever more tightly wound. Despite these concerns, the market shows no sign of slowing. Product innovation continues apace, with new contracts covering everything from space warfare to disruptions in undersea internet cables. Some instruments are designed to respond to hypothetical scenarios, such as the weaponization of artificial intelligence in international disputes. As the boundaries of insurable risk expand, so too does the universe of tradable catastrophe. The opacity of the market makes it difficult to assess the true extent of exposure. Many ESG funds, for example, hold war-linked catastrophe bonds as part of broader portfolios that bundle together a variety of risk instruments. The complexity of these structures can obscure the underlying sources of return, allowing investors to profit from conflict without confronting the ethical implications. This lack of transparency raises questions about the accountability of both issuers and buyers. As the market matures, the process of standardization brings both benefits and challenges. Increased liquidity makes it easier for investors to enter and exit positions, but it also embeds these products more deeply within the global financial system. The normalization of war catastrophe bonds reflects a broader shift in the way risk is understood, not as a threat to be avoided, but as an opportunity to be managed and monetized. The consequences of this shift are still unfolding. Some observers argue that the financialization of conflict exacerbates existing inequalities, allowing wealthy nations and institutions to profit from the instability that afflicts others. Others see it as an inevitable response to a world characterized by chronic volatility and uncertainty. What is clear is that the boundaries between natural and man-made disasters are becoming less distinct, as both are absorbed into the logic of financial markets. In this environment, the ability to assign a price to risk, whether from war, cyberattacks, or climate events, has become a central feature of the global economy. The same tools that model the probability of a hurricane now quantify the likelihood of a missile strike or a blackout. Investors move capital across these domains with little regard for the underlying causes, focused instead on the structure of returns and the reliability of payouts. Financial markets now treat disaster, whether natural or engineered, as a source of value. The instruments designed to manage these risks have become more sophisticated, more liquid, and more deeply embedded in the fabric of global finance. The process of quantifying and trading catastrophe risk has spread from hurricanes and wildfires to the theater of war, reshaping the incentives of both investors and policymakers. The next step is to apply the same logic to the slow-motion crises of climate change. As risk modeling becomes ever more granular, financial institutions have developed a precise vocabulary for environmental destruction. They assign numerical disaster probability scores to regions, updating these figures quarterly in much the same way that credit ratings are revised. This approach allows for the systematic pricing of climate risk, climate change, turning the prospect of future devastation. Financial institutions increasingly treat the planet's shifting climate as a set of numbers to be modeled, priced, and traded. The concept of climate change as an asset class is no longer theoretical. Markets now assign value to the likelihood and severity of environmental disasters, transforming risk into opportunity on a global scale. Banks and asset managers have built out entire infrastructures to quantify environmental risk. Disaster probability scores, once the domain of insurance actuaries, now inform the pricing of municipal bonds, mortgage securities, and even sovereign debt. These scores, updated quarterly, reflect not only historical weather patterns, but also new data streams from satellites, ocean buoys, and sensor networks. A zip code in southern Florida is flagged for hurricane exposure, its score ticking upward each time NOAA revises Atlantic storm forecasts. In Central California, wildfire risk is broken down by neighborhood, with algorithms factoring in vegetation density, wind patterns, and even the number of evacuation routes. The effect on yields is immediate. Florida's hurricane bonds, for example, now offer annual returns of 18%, dwarfing the yields on traditional municipal debt. These instruments have grown more precise, with triggers tied to real-time wind speeds, storm surge salinity, and even the cumulative rainfall measured at specific coastal markers. Investors can track the probability of a payout by the hour, watching as weather models update and risk is recalibrated in real time. California's wildfire bonds have also evolved. No longer limited to direct property loss, contracts now include clauses for smoke damage, business interruption, and evacuation costs. One recent issuance pays out if particulate matter exceeds EPA thresholds for 2 consecutive weeks in the Bay Area, while another is triggered by the number of school days canceled due to poor air quality. The scope of these bonds has expanded to reflect the broader health and economic impacts of wildfires, making them more attractive to investors seeking diversified exposure to climate risk. The market is also beginning to price so-called slow disasters, the gradual, cumulative effects of climate change that unfold over years or decades. Derivatives tied to desertification track the spread of barren land in regions like sub-Saharan Africa, using satellite imagery and ground surveys to monitor vegetative cover. Payouts are linked to metrics such as the percentage increase in arid zones or the loss of agricultural productivity. Rising sea level derivatives, meanwhile, rely on tidal gauge data and long-term projections, allowing investors to bet on the pace of coastal inundation from Miami to Manila. These new instruments reflect a shift in how investors approach climate risk. It's no longer just about insuring against a single hurricane or wildfire. It's about constructing portfolios that capture the full spectrum of environmental volatility. Hedge funds now short regions deemed unlikely to receive adequate disaster relief, betting against the economic prospects of counties with outdated flood controls or cities that delay infrastructure upgrades. Some firms employ former disaster response officials to analyze local preparedness, translating that expertise into trades that profit when recovery efforts fall short. The overlap between climate mitigation and climate profiteering is striking. The same firms that dominate carbon credit trading, selling emissions permits and renewable energy certificates, also structure catastrophe bonds and climate-linked derivatives. A trader might spend the morning negotiating offsets for a European utility, then pivot in the afternoon to package wildfire risk for a California insurer. Internal memos describe this as a climate risk ecosystem, where every environmental outcome, improvement or deterioration, offers a stream of revenue. Municipalities have started to respond by issuing climate resilience bonds, a new class of financial instrument designed to hedge against their own failures. Miami Beach recently floated $400 million in bonds that pay investors only if specific flood protection projects prevent damage during hurricanes. In Norfolk, Virginia, the city structured bonds with interest rates that decrease if sea level rise outpaces projections, effectively transferring some of the risk back to investors. These deals represent a reversal of traditional catastrophe insurance, with local governments betting on their ability to adapt and investors wagering on the opposite. Quantitative analysts have developed climate-specific analogs to traditional volatility metrics. The catastrophe VIX aggregates implied risk across disaster-linked bonds worldwide, while regional sub-indices track wildfire severity in California, typhoon exposure in Southeast Asia, and drought risk in the American Midwest. Trading desks use these benchmarks to rebalance portfolios. In response to shifting weather patterns, executing trades as soon as new data emerges. Underwriting climate-linked securities now requires a blend of actuarial science and environmental modeling. For Texas windstorm bonds, models incorporate decades of Gulf temperature records, historical storm paths, and even shifts in local building codes. The most sophisticated analyses factor in climate gentrification, the displacement of lower-income residents as wealthier buyers seek out safer areas, altering the risk profile of entire neighborhoods. These models are continually refined as new data becomes available, with each update feeding directly into bond pricing and investor exposure. The secondary market for climate risk has grown in both scale and complexity. Electronically traded catastrophe swaps allow investors to adjust positions by the hour, responding to changes in storm trajectories or wildfire forecasts. During the 2024 hurricane season, daily trading volume in Gulf Coast wind derivatives reached $750 million as funds jockeyed for position ahead of each landfall. Algorithmic trading systems execute orders automatically when NOAA updates storm probability cones, moving capital in real time as risk is repriced. Private equity firms have entered the fray, acquiring entire portfolios of climate liabilities from insurers eager to shed exposure. Blackstone recently purchased a $2 billion package of Florida hurricane risks, collecting premiums for years while waiting for the next major storm. Since 2020, over $18 billion in climate-linked liabilities have been transferred from traditional insurers to institutional investors, shifting risk away from the balance sheets of local companies and into the portfolios of global asset managers. The market has also begun to internalize climate feedback loops, where one disaster amplifies the risk of another. Bonds now account for how drought increases wildfire frequency, which in turn reduces watershed capacity and exacerbates future droughts. Some instruments link payouts to indices that track these cascading failures, creating a financial map of interconnected environmental risks. Climate science is distilled into formulas and payout schedules, with each new degradation assigned a corresponding metric. Residential mortgage-backed securities have adapted to this new reality by incorporating climate risk layers. Algorithms evaluate not just borrower credit scores and down payments, but also a property's flood zone rating, wildfire defensibility, and proximity to vulnerable infrastructure. Loans for high-risk properties are bundled into specialized climate mortgage securities, offering higher yields in exchange for elevated exposure. An echo of subprime lending, but based on geography rather than borrower behavior. Corporate issuers have also embraced climate bonds as a tool for managing volatility. Agricultural firms issue securities tied to crop yields that fluctuate with drought and extreme weather. Shipping companies float bonds covering port disruptions from rising sea levels. Even technology giants hedge against data center overheating during heat waves, using temperature-linked derivatives to manage operational risk. The insurance-linked securities market has ballooned, with over $150 billion in collateral now funding climate risks. Pension funds, seeking diversification and uncorrelated returns, have become major buyers. CalPERS, the largest public pension fund in the U.S., allocates more than 4% of its portfolio to weather derivatives and catastrophe bonds, aiming for returns that spike when traditional assets falter. The appeal is clear. Climate-linked securities offer a rare source of yield in a world of low interest rates and high uncertainty. Yet the incentives embedded in these products often run counter to adaptation and resilience. Some coastal communities reportedly delay flood prevention projects because disaster payouts can exceed the cost of mitigation. Farmers in drought-prone regions may plant less resilient crops, knowing insurance claims will offset losses. The logic of the market sometimes rewards inaction and even amplifies vulnerability, as the prospect of financial gain outweighs the incentive to reduce risk. Oversight remains limited. Many climate derivatives are settled through offshore special-purpose vehicles in jurisdictions like Bermuda and the Cayman Islands, beyond the reach of most regulators. Banks repackage risks into increasingly complex structured products, making it difficult to track exposures or assess systemic threats. The memory of the 2008 financial crisis lingers, as some observers warn that climate risk transfer mechanisms could amplify shocks on a planetary scale. Innovation continues at a rapid pace. New products track glacier melt rates and their impact on hydropower generation. Others allow investors to bet on climate migration flows or the frequency of famine declarations. Swiss Re has launched an instrument that triggers payouts based on the number of climate-related emergencies declared by national governments. Each new contract expands the universe of tradable risk, bringing more aspects of environmental change under the umbrella of finance. Financial firms increasingly view the Earth's instability as a form of market inefficiency to be exploited. The models that forecast ecological collapse are the same ones that structure profitable trades. Climate science becomes a set of volatility curves and probability surfaces, raw material for the next wave of financial innovation. The boundaries between risk management and speculation blur, as every disaster, whether sudden or slow, feeds into the machinery of global finance. The paradox is stark. Markets can now price climate risk with astonishing detail, yet these mechanisms do little to address the underlying causes. A trader can calculate the expected loss from a Category 4 hurricane in Tampa down to the dollar, but that knowledge does not prevent the storm or mitigate its impact. Instead, climate change has become a high-stakes game, where financial institutions profit regardless of the outcome. This transformation has shifted the burden of environmental risk away from communities and onto the balance sheets of distant investors. The same mechanisms that once protected homeowners in cities now serve as tools for speculation and profit extraction. The consequences of this shift are still unfolding, as the market for climate risk grows more sophisticated and more deeply embedded in the global financial system. With each passing season, the linkage between environmental catastrophe and financial opportunity tightens. The systems built to manage risk now operate at a scale and speed that few could have imagined a decade ago. The next phase of this evolution is already underway, as traditional insurers move to offload even more risk to the global capital markets, reshaping the relationship between disaster, finance, and recovery. The disaster reinsurance market. Risk, once the responsibility of local insurers, now circulates through a vast and intricate network of disaster reinsurance markets. The industry's transformation is not just about shifting numbers on a balance sheet. It's about the relentless drive to turn catastrophe into a liquid, tradable asset. At the center of this system sits the disaster reinsurance market, a space where the fallout from hurricanes, wildfires, and floods is packaged, priced, and sold to investors around the world. Insurance companies rarely keep the majority of the risk they underwrite. Instead, they transfer exposure to global reinsurers and, increasingly, to financial markets eager for uncorrelated returns. This process accelerated throughout the 2020s as climate-driven catastrophes became more frequent and severe. The result is an ecosystem where the premiums paid by homeowners in Miami or Houston might ultimately fund a London hedge fund's position on the next Atlantic hurricane season. The disaster reinsurance market now handles over $200 billion in contracts annually, with every policy and payout woven into an international web of speculation and hedging. The speed and scale of this market are unprecedented. When a major hurricane forms, billions of dollars in trades can be executed within hours. These transactions are not delayed by the need for damage assessments or government declarations. Algorithms monitor wind speeds, barometric pressure, and satellite data in real time, triggering trades the moment predefined thresholds are met. For certain contracts, even the volume of emergency-related social media posts can become a payout trigger, reflecting the market's hunger for immediate, data-driven signals. Reinsurance trading platforms operate around the clock. As one region's trading day ends, another begins. London hands off to Singapore, then to New York, ensuring that disaster risk is continuously repriced and redistributed. During the 2024 Miami hurricane, a Bermuda-based hedge fund executed $800 million in reinsurance swaps between midnight and dawn, with each new forecast update prompting a flurry of trades. By the time first responders reached the hardest-hit neighborhoods, the financial consequences had already been tallied and traded, often multiple times over. This constant movement of risk is facilitated by a range of complex financial instruments. Hedge funds and asset managers bundle disaster exposures into collateralized debt obligations, CDOs, a structure notorious for its role in the 2008 financial crisis. Today's disaster CDOs combine hurricane, wildfire, and earthquake risks into a single product, which is then sliced into tranches and sold to investors according to their appetite for risk. Ratings agencies assess these instruments using models that, while updated for climate projections, remain vulnerable to the same blind spots that once underestimated mortgage default risk. Institutional investors have become major players in disaster reinsurance. Norway's sovereign wealth fund allocates over $4 billion to insurance-linked securities, while the Canada Pension Plan holds nearly $3 billion in similar assets. These funds are drawn by the promise of returns that move independently from the broader stock and bond markets. Disasters, after all, do not follow the rhythms of financial cycles. Yet this global pooling of risk has unexpected consequences. When wildfires swept through California, pensioners in Oslo and Toronto found their retirement savings exposed to the fate of communities thousands of miles away, creating a feedback loop where catastrophe in one region ripples through portfolios on the other side of the world. The secondary market for reinsurance contracts is vast and opaque, with trading volumes exceeding $200 billion. Most transactions occur over the counter between institutional players, far from public scrutiny. Bermuda has emerged as a hub for this activity, offering regulatory advantages and housing nearly 40% of global reinsurance trades through special-purpose vehicles. These vehicles allow for the rapid creation and trading of catastrophe bonds, swaps, options, and other derivatives, all layered atop the original insurance contracts. In practice, a single hurricane can spawn dozens of related instruments, each with its own payout structure and risk profile. The complexity of these products makes systemic risk difficult to assess. During the 2023 Atlantic storm season, one global bank discovered it had unknowingly taken opposing positions on the same hurricane through different counterparties, a tangle of exposures that only became clear after the fact. The layering of risk and the opacity of the market mean that even sophisticated participants can lose track of their true exposures, a vulnerability that echoes the failures of past financial crises. For local insurers, the shift to global reinsurance has changed their role. They have become conduits for capital rather than true bearers of risk. A small carrier in the Midwest might retain just 10% of its flood policy exposure, selling the rest to a reinsurer in Bermuda, who then packages it into catastrophe bonds for institutional investors. This chain of transactions can leave communities exposed when disaster strikes. After the 2024 Missouri floods, policyholders waited months for claims to be processed, as their local insurer struggled to collect from reinsurers who had themselves transferred the risk yet again. The further risk moves from its origin, the more difficult it becomes to track responsibility and ensure timely payouts. Some firms have carved out a niche in distressed disaster debt, a practice that adds another speculative layer to the market. These players purchase the rights to insurance claims or payouts at a discount, betting that the ultimate payout will exceed the price paid. In one recent example, Anheuser Capital bought $300 million in potential hurricane claims from a struggling Florida insurer at 60 cents on the dollar. When the storm struck, they collected nearly the full amount, pocketing a substantial profit. This strategy is now common enough that several firms maintain standing offers for specific categories of disaster risk, effectively betting on the desperation of others. Financial engineering in the reinsurance market has grown increasingly abstract. Many new contracts reference indices rather than actual damages. A wildfire swap might pay out based on the total acreage burned nationally, regardless of whether the counterparty insures any of those properties. Other instruments use parametric triggers, scientific measurements such as wind speed, rainfall, or ground motion, rather than waiting for traditional claims. This speeds up the process and appeals to investors, but it also detaches the financial product from the real-world suffering that underlies the numbers. Banks that structure these products often profit from multiple sides of the same trade. For instance, Goldman Sachs helped a Caribbean nation issue $650 million in catastrophe bonds to hedge hurricane risk, while simultaneously selling credit default swaps that allowed investors to bet against those same bonds. This dual role creates conflicts of interest, as the same institution earns fees from both the issuer and the speculators wagering on disaster. Brokers routinely match buyers and sellers while also taking positions themselves, blurring the line between facilitator and participant. The influence of disaster reinsurance now extends beyond finance and into the realm of public policy and infrastructure. In Texas, several counties delayed upgrades to flood control systems after analyzing the terms of their reinsurance contracts. The reasoning was simple. The expected value of potential bond payouts outweighed the cost of preventive improvements. In Florida, property developers factor catastrophe bond yields into their construction plans, knowing that certain designs can maximize insurance payouts after a disaster. The structure of the reinsurance market has begun to shape decisions about where and how to build, and even whether to invest in resilience at all. The market's reliance on proprietary models introduces new risks. At several large firms, entire trading books depend on the expertise of small quant teams with unique approaches to catastrophe modeling. When a lead modeler at JP Morgan left for a tech startup in 2024, the bank temporarily suspended issuance of certain catastrophe-linked products, highlighting how concentrated knowledge can become a point of failure. The reliance on complex, sometimes opaque models makes it difficult for outsiders, including regulators, to assess the true stability of the market. Transparency remains a persistent challenge. Most reinsurance trades are conducted privately, with limited disclosure of pricing or exposure. The use of offshore special-purpose vehicles and the layering of derivatives make it nearly impossible for regulators or the public to track the flow of risk. This opacity raises concerns about the potential for systemic shocks, especially as more capital is funneled into increasingly complex and interconnected products. The internationalization of disaster risk has also introduced new dependencies. Local insurers, once the backbone of community recovery, now rely on the willingness of global investors to absorb risk. When capital becomes scarce or expensive, whether due to market downturns or shifting investor sentiment, coverage can dry up, leaving policyholders vulnerable. The cost and availability of disaster insurance in high-risk regions now fluctuate according to the appetite of pension funds and hedge funds in distant financial centers. Despite these vulnerabilities, the disaster reinsurance market continues to grow. The promise of high yields and diversification attracts new entrants every year. Pension funds, sovereign wealth funds, and even endowments allocate increasing portions of their portfolios to catastrophe bonds and insurance-linked securities, convinced that these assets offer protection against the volatility of traditional markets. The market's liquidity and scale allow for rapid deployment and reallocation of capital, but also create the conditions for sudden reversals and cascading losses. As disaster risk becomes just another line item in a global portfolio, the connection between financial innovation and real-world recovery grows more tenuous. The speed and abstraction of the market mean that financial settlements often arrive before emergency aid or government support. In some cases, payouts to investors are triggered and distributed while communities are still waiting for the first responders to arrive. The machinery of finance moves faster than the machinery of recovery. This disjunction is not just a technical issue. It has profound consequences for those living with the realities of disaster. The next section examines how the profits generated in the disaster reinsurance market shape the experiences of affected communities, raising questions about who benefits, who loses, the human cost, and what is left behind when capital moves on. The mechanics of disaster finance rarely pause to consider the aftermath on the ground. The human cost of disaster profits is measured not just in dollars, but in the widening chasm between those who recover and those left behind. For every $1 billion in profits generated by catastrophe bonds, studies indicate the recovery gap in affected communities expands by nearly a third. Bondholders receive their payouts within days of a disaster, while many residents wait months or even years for assistance. In Houston after Hurricane Harold, investors saw full returns within 72 hours of landfall, but local families lined up for relief checks well into the following year. The financialization of disaster creates openings for predatory lending. As soon as catastrophe bond triggers activate, payday lenders set up mobile offices outside relief centers. Their contracts often tie interest rates to anticipated insurance settlements, locking survivors into cycles of debt before they've even taken stock of their losses. In one Louisiana flood, a widow borrowed $15,000 to replace ruined essentials, only to discover the effective annual rate topped 400% once her insurance payment arrived. These practices turn emergency aid into a future claim for lenders, compounding hardship just as recovery begins. The same banks that structure catastrophe bonds frequently return as lenders, offering reconstruction loans at premium rates. In California, Goldman Sachs helped design wildfire bonds worth $2 billion, then extended high-interest loans to the same communities for rebuilding. Loan terms included clauses that increased rates if insurance settlements exceeded certain amounts, ensuring the bank profited from both disaster payouts and the cost of recovery. This cycle burdens affected neighborhoods with debt layered atop loss, and the financial sector extracts value at every stage. Wealthier communities consistently rebuild faster, a pattern baked into the structure of disaster finance. After Miami's 2024 hurricane, homes on Palm Island were restored within 6 months, while low-income housing in Overtown sat empty and damaged for years. The difference lies in insured values. Coastal mansions with high coverage trigger larger, quicker payouts, drawing contractors and resources to affluent areas first. The result is a two-speed recovery, where financial incentives align with wealth, not need. Some catastrophe bond contracts actively discourage mitigation. In Montana, a county discovered its wildfire bond would pay less if it removed flammable underbrush, since reduced fuel loads lowered the potential for damage. The contract penalized proactive fire prevention, tying higher payouts to greater risk. Similar provisions appear in flood bonds, where improvements to levees can reduce future payouts, disincentivizing investment in public safety. The logic of these instruments sometimes rewards inaction, prioritizing the scale of loss over the effort to prevent it. Rising insurance costs in climate-vulnerable regions push long-time residents out of their homes. In Florida, hurricane zone premiums have tripled since 2020, forcing many working-class families to forego coverage. Lenders often call in mortgages when insurers redline entire zip codes, accelerating displacement. This dynamic fuels climate gentrification, as wealthier buyers acquire devalued properties, confident that their catastrophe bond holdings will cover future damages. The original fabric of these communities unravels, replaced by a population able to absorb or profit from risk. Municipal governments also struggle under the weight of disaster finance. Detroit's wastewater department took out catastrophe-linked loans to upgrade infrastructure after repeated floods. The fine print tied interest rates to future disaster declarations, so each new flood made the city's debt more expensive. As maintenance budgets shifted to debt service, infrastructure decayed further, creating a feedback loop of vulnerability and financial strain. Disaster capitalism produces a two-tier recovery system, visible in every major catastrophe. Following the 2025 Texas freeze, hospitals in wealthy suburbs restored power within hours using catastrophe bond proceeds. Public hospitals waited weeks for state aid, resulting in preventable deaths. The difference was not in the level of need, but in which facilities held policies tied to fast-acting financial instruments. The financialization of risk doesn't just dictate who gets paid. It shapes who gets help, and when. The influence of these markets extends into daily life well before disaster strikes. In fire-prone parts of California, insurers now require homeowners to remove trees and vegetation to maintain coverage. Neighborhoods shift from leafy suburbs to stark, rock-strewn landscapes as residents comply with insurance models that dictate land use. What was once a community aesthetic becomes a function of actuarial tables and risk algorithms. Food access suffers under this system. After Nashville's 2024 floods, grocery stores in low-income neighborhoods waited months to reopen, while high-end markets resumed business within weeks. The difference was catastrophe-linked business interruption policies with favorable triggers. Residents in underserved areas traveled miles for basic groceries. Their recovery slowed not by the scale of damage, but by the financial instruments backing their local retailers. Education gaps widen as well. Wealthy school districts rebuild quickly using bond proceeds, while poorer districts depend on slower government aid. After Oklahoma's 2025 tornado outbreak, affluent districts reopened in temporary facilities within 2 weeks, while high-poverty schools remained closed for half a year. The academic setbacks for vulnerable students are lasting, and the disparity grows with each new disaster. Displacement is another persistent consequence. When catastrophe bonds trigger payouts for damaged rental properties, landlords often renovate units to attract higher-income tenants. After the Pacific Northwest heat dome, thousands of low-income renters in Portland were permanently displaced, their former homes transformed into luxury apartments with climate controls, financed by disaster bond proceeds. The cycle of loss and redevelopment erases affordable housing and fractures communities. small businesses face a different set of challenges. A Seattle restaurant owner paid tens of thousands annually for catastrophe coverage, only to learn her policy excluded the heat dome conditions that closed her doors for 3 weeks. Meanwhile, hedge funds had written weather derivatives specifically for those conditions, collecting payouts while traditional policyholders were left out. The granularity of these financial products often leaves local businesses exposed, even as capital flows to those who engineered the risk. Hospital systems must navigate the same terrain. Public hospitals lacking catastrophe bond coverage struggle to compete with private facilities that have secured favorable reinsurance terms. After major hurricanes, bond-protected hospitals in Florida reported higher margins and faster recovery, while uninsured facilities in other states faced budget shortfalls and service cuts. The result is a growing divide in healthcare, where access and quality depend on a facility's place in the financial risk chain. Mental health impacts remain largely invisible in disaster finance. Depression and anxiety spike among survivors facing prolonged displacement, but bond structures prioritize physical damage over psychological harm. One Houston mother received a check for her flooded home within days, but her daughter's therapy for post-traumatic stress was not covered by any disaster-related financial product. The models that drive payouts rarely account for the full spectrum of loss. Cultural damage is similarly overlooked. When wildfires destroyed sacred Native American sites in the Southwest, bond triggers measured only the cost of rebuilding physical structures. The spiritual and cultural significance of the land was absent from financial calculations, leaving communities without resources to restore intangible heritage. The same pattern holds for historic churches and community centers lost to disaster, their value reduced to line items in a claims ledger. Elderly residents face particular vulnerabilities. Many seniors on fixed incomes struggle with rising premiums and exclusionary policy language. After Phoenix's 2025 heat catastrophe, several assisted living facilities closed because their policies excluded ambient temperature events. Meanwhile, hedge funds collected on temperature-linked derivatives tied to the same weather patterns. The gap between those protected by financial innovation and those left exposed grows with each event. Disaster response itself has become a function of finance. Private firefighting firms now contract directly with insurers, prioritizing properties covered by catastrophe bonds. During California's record wildfire season, some households reported private crews defending mansions while neighboring homes burned, as contracts covered only specified high-value properties. The logic of the market determines whose losses are prevented and whose are left to fate. Climate migration patterns increasingly reflect the flow of capital. As insurance becomes unaffordable in vulnerable areas, residents relocate to regions with more stable pricing, often shaped by reinsurance markets. Retirees leave Florida not because of fear of hurricanes, but because catastrophe bond activity has made premiums untenable. These demographic shifts, driven by financial pressures, reshape entire communities. City budgets now factor in the financial sector's share of disaster recovery. Every catastrophe bond payout represents funds diverted from local rebuilding efforts. Miami's most recent resilience plan reduced projected federal aid by a quarter, accounting for investor profits that would siphon relief into financial markets. This leaves less money for essential services, from infrastructure upgrades to emergency shelters. The financial products themselves are increasingly detached from lived experience. New catastrophe bonds pay out based solely on parametric triggers, wind speeds, flood gauges, or seismic readings, without requiring proof of actual damage. Investors can collect returns even when the physical impact is minimal, provided the right metrics are met. In 2024, some bonds paid out for Hurricane Leslie despite little land damage, highlighting the disconnect between financial instruments and real-world suffering. Labor markets respond unevenly to disaster finance. Construction workers in affluent areas find immediate employment as rebuilding begins, while those in poorer neighborhoods wait months for projects to start. Prosperity concentrates in networks connected to well-insured clients, widening income gaps even as the broader community struggles. Farmers, too, are exposed to the limits of financial innovation. While hedge funds trade agricultural derivatives tied to weather patterns, most small producers rely on traditional insurance that often denies claims for new climate realities. A Nebraska wheat grower endured 5 years of drought-related losses, none covered because damage thresholds referenced outdated historical averages. The benefits of financial engineering accrue to those who can afford bespoke products, not those who bear the brunt of shifting weather. The tax code amplifies these disparities. Catastrophe bond investors often qualify for special tax breaks on disaster-related profits, while local governments and residents shoulder the costs of recovery without similar benefits. This structure reinforces the flow of capital away from affected areas and toward global financial centers. Each of these outcomes traces back to the central logic of disaster finance. Risk is commodified, traded, and monetized, while the lived realities of recovery remain secondary. The systems designed to manage catastrophe have become so efficient at extracting value that they often deepen the very vulnerabilities they claim to address. As the market for catastrophe bonds expands and financial innovation accelerates, the consequences for communities become more complex and far-reaching. The next phase of this evolution will be defined not only by new instruments and technologies, but by the scale and speed with which risk is repackaged and sold. The trajectory points toward a future where the stakes and the divides grow larger with each passing season. The future of catastrophe bonds. Against the backdrop of growing divides in disaster recovery, the future of catastrophe bonds is taking shape in ways that will define the financial landscape for years to come. The market's expansion is not simply a matter of scale, but of transformation. New risks, new technologies, and new actors are reshaping how catastrophe risk is measured, traded, and ultimately experienced. Projections for 2025 show the catastrophe bond market on track for another year of strong growth. Broker-dealers expect new issuance to reach between $15 billion and $19 billion, with the midpoint of $17 billion representing a continuation of the upward trend that has characterized the past several years. This momentum is fueled by both the steady maturation of existing deals and the arrival of new sponsors, including governments, corporations, and even public utilities seeking to hedge increasingly unpredictable risks. The total outstanding market has crossed $52 billion, and analysts see few signs of slowdown. The Swiss Re Cat Bond Index, which tracks the performance of these instruments, delivered a 17.3% return in 2024, the second highest on record. These returns, coupled with the expansion of the types of risks that can be securitized, continue to attract capital from institutional investors hungry for uncorrelated yield. The investable universe of catastrophe bonds is broadening beyond traditional perils. While hurricanes, earthquakes, and wildfires remain the bedrock of the market, new instruments now address risks that were once considered uninsurable. Cyber catastrophe bonds have emerged as a prime example. In 2023, UK specialty insurer Beazley issued the first cyber catastrophe bond, raising $45 million, followed by another $140 million deal in early 2024. These bonds are triggered by predefined metrics, such as the number of records breached, the scale of distributed denial-of-service attacks, or the duration of business interruption. Their modeling draws on AI-powered analysis of global threat intelligence, dark web chatter, and real-time network activity. The growth of cyber cat bonds signals a shift. Risk transfer is no longer limited to natural forces, but now encompasses the engineered vulnerabilities of digital infrastructure. Other frontiers are opening as well. Pandemic bonds, once criticized for their failures during COVID-19, are being reimagined. The latest prototypes incorporate real-time genomic sequencing, international airline passenger flows, and global disease surveillance. Triggers are tied not just to the spread of pathogens, but to disruptions in pharmaceutical supply chains and vaccine production bottlenecks. The intention is to create instruments that respond to the realities of modern pandemics, rapid, global, and shaped by both biology and logistics. Biodiversity collapse is also entering the market's calculus. Experimental bonds now track metrics like species extinction rates, forest cover loss, and coral reef bleaching. The World Bank has piloted instruments that pay out when wildlife monitoring systems detect significant population declines in protected areas. These products appeal to investors with environmental mandates, but they also raise uncomfortable questions about the commodification of ecological loss. The line between hedging risk and monetizing destruction grows thinner as new categories are added to the catastrophe bond universe. Underpinning this evolution is a technological arms race in catastrophe modeling. AI and machine learning systems have transformed the speed and precision with which risk is assessed. During the 2024 hurricane season, some models recalibrated bond valuations every 12 minutes, digesting streams of data from the National Hurricane Center, commercial satellites, and even social media posts from affected regions. Quantitative analysts now value portfolios on an hourly basis, adjusting exposures as storms shift course or new data arrives. The integration of AI with geospatial data and high-resolution satellite imagery allows insurers to map risk at the level of individual properties or infrastructure assets. These advances enable more granular underwriting, but they also heighten the market's sensitivity to incoming information, creating the potential for rapid repricing and volatility as new risks emerge. The workforce supporting this market is changing just as quickly. Where once catastrophe bond structurers required actuarial expertise, today's teams are just as likely to include machine learning engineers, cyber risk analysts, and even former intelligence officers. Banks and hedge funds recruit directly from scientific research programs, luring glaciologists, epidemiologists, and climate modelers with the promise of high bonuses and the chance to work on novel financial products. Internal competitions, so-called disaster hackathons, reward teams that develop the most predictive models, whether for monsoon rainfall, wildfire spread, or geopolitical conflict. The talent arms race mirrors the technological one, with firms vying for the best minds to maintain a competitive edge. Retail investors are being drawn into the catastrophe bond market through new exchange-traded funds and structured products. Asset managers have begun to develop disaster ETFs that bundle cat bonds with reinsurance-linked securities, offering exposure to hurricane, earthquake, and wildfire risk in a single vehicle. Some of these funds employ AI-driven allocation strategies, dynamically shifting exposures based on forecasted seasonal patterns. The democratization of catastrophe risk appeals to investors seeking diversification, but it also introduces complexity. The underlying risks are often opaque, and the mechanics of payout triggers can be difficult for non-specialists to grasp. Consumer advocates warn that retail investors may underestimate the volatility and potential for loss inherent in disaster-linked securities. Financial innovation is also changing the way catastrophe bonds are traded. Blockchain platforms now allow for the tokenization of cat bonds, enabling 24/7 trading of fractionalized risk exposures. On a Bermuda-based exchange, investors can buy and sell NFTs representing slices of catastrophe risk, with prices updated in real time as new data becomes available. Proponents argue that this approach increases liquidity and transparency, but concerns remain about market manipulation and the potential for panic selling during unfolding disasters, when information is scarce and uncertainty is high. A proposed global disaster index, modeled after equity market volatility benchmarks like the VIX, aims to aggregate risk across all catastrophe bond categories into a single, continuously updated metric. Early simulations show that such an index would spike dramatically during periods of clustered disasters, such as the Pacific Typhoon Cluster of 2023, when backtested values surged over 300%. Supporters argue that a standardized risk benchmark could improve market efficiency and help investors manage exposures across disparate perils. Critics counter that it could introduce new forms of systemic risk, as automated trading strategies might trigger broad sell-offs in response to index movements, amplifying volatility. In times of crisis, central banks and public institutions are beginning to participate directly in the catastrophe bond market. The Bank of England, for example, has included $800 million in climate-linked cat bonds as part of its quantitative easing program. The European Central Bank has discussed using catastrophe bonds to hedge against Eurozone exposures to Mediterranean wildfires and North Sea flooding. This official sector involvement blurs the distinction between public risk management and private profit, embedding catastrophe bonds more deeply within the machinery of global finance. The boundary between insurance and speculation continues to erode. Sports betting platforms in Nevada now offer disaster derivatives, allowing users to wager on the landfall location of hurricanes or the total acreage burned in wildfires. These products mimic the parametric triggers of catastrophe bonds, but are targeted at retail gamblers rather than institutional investors. Regulators have approved betting markets tied to official disaster declarations, further entwining finance and chance. Ethical and transparency challenges multiply as catastrophe bonds become embedded in mainstream portfolios. ESG funds, seeking to meet environmental and social mandates, sometimes hold cat bonds through complex structured products, unaware of the underlying exposures. A green mutual fund may inadvertently include wildfire risk bundled into a collateralized debt obligation. The opacity of these arrangements makes it difficult for investors to assess whether their capital supports resilience or simply monetizes loss. As financial engineering outpaces disclosure requirements, socially conscious investing becomes more challenging. Regulation has struggled to keep pace with innovation. Catastrophe bonds straddle the line between insurance and securities, creating gaps in oversight. Data disclosure remains inconsistent, with issuers free to determine what information is shared with investors. Ben Brooks of Moody's notes that this lack of standardization drives market inefficiencies, as sophisticated players exploit information asymmetries at the expense of smaller investors. Calls for centralized data exchange systems have grown louder, with advocates arguing that greater transparency would improve pricing and reduce systemic risk. The infrastructure of trading itself is evolving. Reinsurance marketplaces increasingly resemble stock exchanges, offering standardized catastrophe swap contracts with daily mark-to-market pricing. On the Bermuda Commodities Exchange, traders can take positions on hurricane frequency or earthquake magnitude, much as they would on oil futures or currency pairs. This formalization brings liquidity and new participants, but it also raises the risk of speculative bubbles that may become untethered from underlying physical realities. Financial markets now move faster than adaptation efforts on the ground. The influx of capital into catastrophe-linked instruments outpaces investment in resilience or mitigation. Models become more sophisticated each year, their forecasts more granular, but the incentives remain tilted toward profit extraction rather than prevention. The prospect of multiple, simultaneous disasters triggering payouts across interconnected markets is a source of growing concern. Some observers warn of an eventual reckoning, where cascading losses test the system's ability to absorb shocks. Yet the potential for catastrophe bonds to drive positive change remains. Some propose restructuring these instruments to fund resilience projects directly, tying payouts to the successful completion of flood defenses, wildfire mitigation, or infrastructure upgrades. Others advocate for greater integration of social and environmental criteria into bond design, so that capital flows reward not just accurate prediction of loss, but meaningful reduction of risk. The debate continues over whether financial innovation can be harnessed for the public good, or whether it will remain a mechanism for monetizing suffering. As the catastrophe bond market grows more complex and interconnected, the questions it raises become more pressing. The drive to quantify, price, and trade disaster risk will continue to shape not only financial portfolios, but the lived experience of communities on the front lines of climate change and systemic shocks. The systems built to manage risk now operate at a scale and speed that can outpace both recovery efforts and regulatory oversight. In the end, catastrophe bonds reveal the extent to which finance can transform even the most unpredictable forces of nature into assets to be bought and sold. The market's evolution offers both promise and peril, with the balance between resilience and speculation still uncertain. The world of disaster finance continues to expand, drawing in new risks, new technologies, and new participants, each seeking opportunity in the shadow of crisis. What this means for the broader financial system and for the communities most exposed to disaster remains an open question. The answers will depend on how these instruments are used, who benefits from their growth, and whether the logic of profit can ever be aligned with the needs of those most at risk. The rise of the catastrophe bond market, now valued at over $50 billion, highlights the financial sector's ability to turn disaster into opportunity. Extreme weather events and climate risks have become numbers in a global marketplace, with investors optimizing returns from the fallout. These instruments do not prevent destruction. They channel capital to those who can best anticipate it. This approach raises difficult questions about the ethics of profiting from crisis. As models become more sophisticated, the focus remains on extracting value from catastrophe rather than reducing vulnerability. If the system is to serve more than just its investors, its incentives must shift toward resilience and prevention.